We're going to get right into it. So next week, we've got the big Jackson Hole meeting. This was an incredibly important pivot point in the market last year and sent us from near all-time highs to the October lows. That was just a direct shot down, and because there was a big reality check for markets. And I think that there might be some sort of reality check again. Many may think that everything is factored into the market. We know what the Fed's going to do. How could they possibly surprise us? But this is the same kind of thinking we have seen literally the entire time the Fed has been speaking at last summer's Jackson Hole, at every single Fed meeting since. People thinking this is the last one, it's done, the Fed's good to go, we're on top of it, bottoms in, buying the dip, getting ready for the new rally, and then all of a sudden they do another hike and they talk about more hikes. And historically, that has been a surprise to the markets. The markets have adjusted pricing, but that has not been the case. There's other reasons to that. Earnings have come in better than feared, and there's other things. So I'm not trying to hate on that or anything like that. I'm just trying to accurately paint the picture of the Fed and of Jackson Hole. And many may think, oh, we're done with the hiking cycle, basically. Maybe we have one more hike in. Maybe, what does it even matter, right? Well, hold on a second. Let's start with the name of this meeting. The name of this meeting that the Fed has chosen for its Jackson Hole Symposium, which is not any typical FOMC meeting. This is not a rate hike decision. This is a symposium where they gather, talk about the economy in Jackson Hole, relaxing. They're being philosophers about things. And it's not more of the same. It's not return to normal. It's not we're just going right back to COVID markets or anything like that, okay? The name for this meeting is Structural Shifts in the Global Economy. So, what structural shifts could they be talking about? I have a few ideas. One, the day before SVB failed, Jerome Powell said the following quote: "The era of secularly lower rates is likely over." I think this is a particularly important part of the possible future. Low interest rates defined the last decade, arguably the last 2 decades. Since the great financial crisis, we have essentially been in a low interest rate bubble. They solved the great financial crisis by taking the leverage in the system that was over leveraged and moving it to the Fed balance sheet. Simultaneously, they exported inflation out to China. More on that later. When we initially began the quantitative easing during the '08 financial crisis, Ben Bernanke said, yes, we're going to expand the balance sheet, but we are going to bring it down. They never brought it down. When they didn't bring it down, Obama kept expanding it. Trump became president. They expanded. They basically flatlined it. And then they tried to lower it a little bit. They tried to bring interest rates back up to normal. And in like 2 months, the market fell 20%. 20%. So they stopped. And then we had COVID. And then things blew out of proportion and we got inflation. We went to the zero lower bound. We bought a ton of debt. The Fed bought a ton of debt from the market, printed a ton of money. And now my theory is they are for real with bringing down the balance sheet, with ending the idea that they can just monetize the deficit. They have said this. They have addressed the idea when the whole fiscal debate was going on, the ceiling. This is what they were saying. Don't expect the Fed to provide support. They didn't provide support. They didn't do anything to solve any of the banks that they didn't already do. The discount windows, no new things. This is not the COVID Fed anymore. This is a Fed that wants to preserve the dollar and end inflation, which in the long run, we can be very thankful for. In the short run, we're going to have a painful deleveraging. That's just the reality of the situation. That's what China's going through. That's why you're not seeing too much stimulus yet out of China. Because they're just going to pour more gas on the fire if they do that. So, structural shifts in the economy. That my thoughts are, we'll obviously get the truth in a week, but my thoughts are, based on everything I look at, that the era of secularly lower interest rates is over, according to Powell, and the era of structurally higher interest rates is returning. Not that it's going to be some 18% high interest rate, but that it's not going to be a 2 or a 3% 10-year. That's not what I think. I think 4, 5, 6, 7, depending on the economy. When the economy is so flat, we'll be a little closer to 4%. We'll be at 2.5% Fed funds rate. When the economy is booming, we'll be closer to 6 to 7. This way, we don't get an economy that overheats too much and causes inflation. And when we get an economy that begins to weaken, the Fed has ammunition. Imagine this. Let's say in 2021, the economy began to hit a recession. Just something happened, the economy began to hit a recession. The Fed could do nothing. They could do nothing. That would be the end. That is the Great Depression. Interest rates are already at zero. The Fed is doing maximum quantitative easing, so much so that inflation has started, and we hit a recession. That's stagflation. That is the worst possible outcome. It's not normal for the 10-year to be 3 or 4%. You listen to Ray Dalio. You listen to Warren Buffett. They don't buy the long-term debt. That's a problem. Warren Buffett used to when interest rates were more practical. But we've had a Fed buying all the debt, monetizing the deficit, making laws. There are laws that banks have to participate in buying this debt. This is not normal market function. So, I think we're returning to normal market function in the future. That's what, at least I hope. That's what I see based on what's going on here. I think that's ultimately a good thing. I think that's a very good thing. So I hope that's what happens. I think that's what's happening. Now we're returning back to the China question I mentioned earlier. Another structural shift in the global economy is the onshoring and the friendshoring of manufacturing from China. This is obviously a very much unknown situation. One thing we do know, though, is that we have exported inflation, imported deflation, by taking advantage of China's low cost of labor. That has also, though, led us with strategic vulnerabilities. We don't know how to make things in this country. Not that well. Not as well as we should. Not as well as we used to. So we are going to regain skills in this country. We are going to hopefully regain labor, things like that, but at a price. Possibly structurally higher inflation. So that's fine. That whole thing is fine if we get structurally higher interest rates to help keep it a little cooler, keep everything in check. And I think that's what might happen. That's what I'm seeing here. So I think structurally or secularly higher interest rates, not structurally higher interest rates or anything like that. Not some sort of, we went like this, now we're going to go like this in perpetuity. No, just that we played with fire. We tested being too low for too long, doing too much. It's a drug. We got high on inflation. Now we are returning to not the COVID normal, not the normal we used to know, but the long-term normal. The normal when we went on the moon. These kinds of things. When people weren't obese. We weren't a bunch of fat cats. That normal. That's where I think things are going. Now, that is late next week, the Fed meeting. Until then, let's talk about the pullback we've had. It's been a dense pullback. I'm not saying it's over, but it's been a dense pullback. We can give it to the bulls. The bulls can have it for a few days next week. Let's let them have it. NVIDIA earnings, let's let them have it. We'll reevaluate whether or not the bulls are right, that this is going to be some sort of no big deal. We're just going right back to normal, right back to COVID. Shredding money doesn't matter. None of this matters. We're just going to new all-time highs, going to the moon. No bull, no euphoria. Just going straight up, buying stocks, disregarding PE, all this stuff. Just going to completely forget about it. We'll decide that depending on what Jackson Hole is. If it's what I think it's going to be, return on investment's going to matter. People are actually going to consider buying treasuries again as an open idea in their asset allocation. 60-40 might return. Very crucial to the economy long term. We might get to a more healthy, not drug-induced environment. That might be what happens. But we will know that on Jackson Hole. Until then, we'll let the bulls have it. So, that's today's video. And until next time, peace out.